with one of my favorite guests of all time, Dr. David Ranson, who is a hidden gem. You know, a listener turned me on to you, Dr. Ranson, and he said, you got to listen to this guy. And
thank you.
You're a real gem. We love having you on the program. My listener friend, actually, who views you as one of his all-time heroes, he had a great question for you. I'll be sure to ask the question he gave me. From Dave, he says, is the inflation rise we see now temporary due to supply chain disruption, or is it permanent? Is inflation temporary, transitory, or of a more lasting nature? Not permanent, but you know what I mean.
Yeah, I think it has nothing to do with supply chain disruptions. Inflation comes from a weakening of the demand for dollars. The dollar is a unit of currency, which actually is nothing more than a cipher. It's just a concept. It doesn't have anything built into it at all. And so our whole monetary system is based on it, nevertheless. So public confidence in the dollar is absolutely essential to have our monetary system work properly. And if the government carries out actions which cause public confidence in the monetary system to deteriorate, then they sell dollars rather than buy them. The markets do this for them, and the dollar depreciates relative to something, any other asset which is more stable. And the best asset to measure this would historically always have been precious metal. And we are seeing a fall in the dollar relative to precious metal recently, but it's not a tremendous, well, it's going both ways. It is difficult to tell whether it's permanent or sustained or not. We can't measure it very precisely. We can't use the price of gold that is well known because gold is a safe haven investment. And as anxiety about the economy fluctuates, and particularly we've been very anxious, of course, about the pandemic, and we also have anxiety arising from war scares in the Middle East. These things affect the price of gold tremendously, and they're distorting it. But as the pandemic is slowly going away, anxiety is diminishing, and that tends to make the price of gold fall. And this is a misleading signal. The price of gold, the price of a really stable asset would be rising. And the way to measure this is to look at gold or estimate what the price of gold would be in very far forward or futures markets. But that's a technical issue, difficult to describe. But I'm working on it, and it does seem to work.
And what is that? I know you mentioned that on our show last time. Is there a way to summarize that in plain English quickly?
Well, take the oil industry as a parallel. When you buy and sell oil as a businessman, you very rarely are buying and selling the actual commodity. You go to the futures market instead, and you buy a contract to deliver oil that may be consummated maybe 2 years from now. It may be 5 years from now or even 10 years from now. And so there's a whole price structure for oil quite separate from the spot price. And it's the futures prices that receive the most weight when analysts are looking at the oil industry. Well, the same should be true of gold, but it is not customary to worry about the futures
so
market in
what
gold.
someone is willing to pay for oil 2 years from now? So what is someone willing to pay for gold 2 years from now? That would be a good measure of whether we have inflation or not. And someone might be very willing to pay for gold in 2 years because they think inflation's higher. Is that the thought?
Yeah, let me give a practical example. Suppose the Iranians or somebody from the Yemen actually succeeded in seriously bombing one of the Saudi Arabian oil fields. There would be an immediate scarcity of oil. So the spot price of oil would jump. But the futures price of oil, say 5 years out, and we have a fairly active futures market for oil at various horizons, would not be so affected because the markets know that whatever damage is done to the Saudi oil fields can be repaired. And over a period of 2 or 3 years, the repair will take place and the price of oil will go back to what it was before. So if you were trying to make a transaction in oil that would be consummated 5 years from now, you wouldn't be particularly worried about the bombing of the airfield, about the bombing of the oil field. So the price of oil in the futures market is a much more stable, long-term indicator of the value of oil as a resource. Same thing with gold. Gold, in its natural form, is a hedge against inflation, and therefore the price of gold is a measure of how much inflation we should be worried about. But if we look 5 years into the future, the distortions that may exist in the present will not be serious, and we can get a better measure of the inflation potential from that 5-year data than we can from the current price.
And when we get back from our next break, we're going to talk about, well, what does that futures price in gold indicate right now about inflation and more. This is Josh Jalinski, the financial quarterback, with David Ranson, taking your questions on youtube.com. And again, if you miss any of this exciting broadcast, you can go over to the iHeartRadio app or Spotify right now. And folks, call us at 888-988-JOSH, and we will make David's latest write-up free when you schedule and keep your own 45-minute ultimate financial game plan. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski, the financial quarterback, with David Ranson of HCWE, HC Wainwright Economics. So what does the futures market in gold tell us? Gold and silver, as indicated by kind of the ETFs, GLD and SLV, are kind of down lately. What does the futures market tell us?
The futures market has been telling us since the beginning of the year that the dollar is losing value, and not just the US dollar, but many other currencies around the world. And this was actually consistently happening from the very beginning of the year until about midsummer, and we had a cumulative decline in the value of the dollar, measured this way using the futures market for gold, of about nearly 20%. That implies 20% inflation, roughly. And indeed, the best indicator, immediate, timely indicator of inflation suggests that we have, in fact, had, since that time, about 20% inflation. Most of our official indexes of inflation are constructed in such a way that they give a much lower number.
Yeah, they're manipulated
unless you
by the
wait
government.
Another year or two.
And you know how I think you're right about the 20% number? Just look at a bag of potato chips, right? You get 20% less than you did about a year now. You know, I would always say, okay, look at potato chips because the bag would be half. Now the bag is 3/4 of the, you get 3/4 air and 1/4 potato chip. When you buy.
Yeah, the standard example of this is the Hershey Bar.
Yeah.
I think it's a true story, although I've never researched it. But back in the 1940s, there was a Hershey Bar that had, I don't know how many ounces of chocolate in it. And at some point, the company decided to reduce the amount of chocolate, but keep the price the same. Well, of course, the price isn't really the same because we should be measuring the price as how many ounces of chocolate you get for $1. But that isn't the way it was done at that time. So you can distort a price index if you don't take account of whether the piece of material or goods or services that are being valued are remaining the same over time. Well, economists have gotten more sophisticated about this over time, but there's a heavy tendency for the value of what you buy and sell to be changing all the time, especially if we're talking about services rather than goods. In the case of a Hershey bar or a bag of chips, these are things that are almost commodities. And you really can't hide the price of a commodity unless you conduct something like this Hershey bar experiment, which nobody would accept today. But in the service industries, take getting a haircut, for example, I always pay the same amount for a haircut, but I don't always get the same haircut when I pay for it. Sometimes I have to queue up. Sometimes it's plenty of time and I get a much better haircut. Sometimes the hairdresser pays attention to what I ask for and sometimes not. But the price of my haircut is always the same, and that's what goes into the government's index. And so the government's index is not taking account at all of changes in the value of haircuts generally.
Do they take into account the cost of Hershey bars?
Yes, I don't know the story. As I say, I haven't researched it, but I think they do now measure candy as the number of dollars per ounce of chocolate or whatever the candy item is.
But what they're not seeing is now, right? And this is, I also think, where you have inflation. I like chocolate. I don't buy Hershey's anymore. You know, you buy Lily's chocolate because it has no sugar and it has stevia in it. You know how much a Lily's chocolate bar costs? $3.50. Or if you buy, if you go down the chocolate aisle at ShopRite or wherever, you know, Stop and Shop or Gennardi's or wherever you buy your groceries. I don't know where you buy them in Oregon. What's the place by you? The groceries.
Well, we belong to Costco, so we buy a lot of this stuff in larger amounts.
Yeah, Costco. So you buy colon cleansing quantities of chocolate, and now it's much greater volume. So as we talk more about this whole subject, so are you a believer in transitory inflation or permanent? What do you think?
I think the simple answer is it is sustained. I wouldn't say permanent, but it's not transitory. And the main reason why it's not transitory is that a lot of this inflation all took place months ago, and it's already happened. And we now have to wait until our price indexes very slowly reflect it properly. That's why I mentioned the Producer Goods Index, because it is an index that doesn't really wait much. I have estimated how long it takes for it to reflect the amount of depreciation in the dollar, and it's only a matter of 4 or 5 months. But the CPI that everybody works with, that takes 1 year, 2 year, 3 years to fully reflect the inflation that has taken place. It may take even longer than that.
So I bought a new van that was, seats like 12 or 15 passengers for my 7 children. That van was going for $45,000, fully loaded, including taxes. Now that van is about $69,000 if you were to buy that van today. It's crazy. Proves your point that it's about 20%, although that's greater than...
Percentage too, yeah.
That's much greater than... probably due to the metals and the chips and all that stuff. That might be a little transitory. But...
Well, I mentioned Hershey bars, but actually being English, I don't eat American chocolate. I still eat British chocolate. And you will occasionally see the brand Cadburys in the grocery store. And I buy it online where I can get much better prices. But in the store, I watch the Cadbury's prices just as a way of measuring what's going on. And they too are up 20-25% from what they were at the beginning of this year.
So as we are figuring this whole thing out, let's look to Cadbury's. Is Cadbury's better than Hershey's?
For my taste, yes, but you might not agree with me if you tasted them. It's all a matter of taste.
Is Cadbury's creamier? More milk fat?
It is milk chocolate, yeah. Hershey's do sell milk chocolate, but they also sell the regular chocolate, which doesn't have any cream in it. So you can have it both ways with Hershey.
Do you like the cream or no cream? The cream.
I definitely like the cream. I take cream in everything.
The European chocolate is creamier, although I like dark chocolate for the health profile.
Yeah, Belgian chocolate is really superb.
Yeah, you can't beat.
And they put a lot of effort and skill into producing it, so it is actually quite a bit more expensive than our chocolate.
Yeah. So, folks, give us a call, 888-988-JOSH, if you want David Ranson's latest work for HCWE. We'll provide that at no charge when you schedule and keep your no-obligation review at 888-988-JOSH.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.